Welcome to EY.AI Unplugged Season 2, AI Agents of Impact, a special series by EY India Insights. In this episode, The Economic Shift of Agentic AI in Financial Services, we examine how autonomous decision-making AI systems are redefining the financial service ecosystem from risk and compliance to customer engagement and capital allocation. Our guest for today is Pratik Shah, partner and national leader of financial services at EY India. Pratik works closely with banks, insurers, and financial institutions on large scale transformation programs, helping them navigate regulatory change, digital disruption, and the adoption of advanced AI at enterprise scale. Pratik, a very warm welcome to you and thank you for joining us today.
Thank you, Palvi.
So, Pratik, to begin with, how is agentic AI reshaping the financial service ecosystem from autonomous risk assessment to intelligent portfolio management?
So, Palvi, Agentic AI represents a fundamental evolution from your typical traditional automation or predictive analytics. We are moving from AI that supports decisions to an AI that can orchestrate decisions with obviously well-defined guardrails. For example, in risk assessment, agentic systems can continuously monitor transactions, movements in markets, customer behaviors, regulatory signals, and then act in real time by triggering controls, escalating issues, or rebalancing exposure. What's important is that these agents can now operate across systems, platforms, risk engines, compliance tools, enabling a more integrated and a very responsive financial ecosystem. The result is faster decision cycles, improved resilience, and better alignment of risk, return, and regulation. So we are actually entering a very interesting regime for an end-to-end process using agentic AI rather than on a standalone basis.
Thank you, Pratik. In what ways does the rise of self-directed decision-making AI systems mark a fundamental shift in the structure and the operation of India's financial economy?
See, this shift is structural, not incremental. India's financial economy has traditionally relied on centralized decision making and a lot of human-intensive processes and controls. Agentic AI introduces a distributed intelligence model where decision authority is embedded very closer to the real events as they happen. Given India's scale, millions of customers, and the high transaction velocity, and the kind of diverse risk profile, the agentic AI model is particularly powerful. AI agents can now operate continually across geographies, languages, customer segments, enabling financial institutions to respond with speed and precision, which was difficult earlier. At a macro level, financial institutions, as they scale, this becomes a very differentiated tool for them. The growth is no longer then constrained by operational headcount or a linear expansion. Instead, intelligence itself becomes scalable, allowing institutions to serve more customer, manage risk more dynamically, and operate very efficiently within obviously the guardrails and the regulatory framework. So it definitely is a very structural shift as far as how financial services institutes will operate.
Thank you, Pratik. Adding to the previous question, how can India's financial institutions leverage agentic AI to unlock new sources of value, efficiency, and inclusion in fast evolving marketplace?
Clearly, there are three value levers. There is efficiency, there is personalization, and obviously inclusion. Efficiency standpoint, agentic AI can autonomously manage end-to-end workflows, be it, right from the time a customer is onboarded to credit assessment, to claim processing, collections, and obviously the end-to-end process. So there is a significant amount of cost that can be managed and a turnaround time that can be improved purely from an efficiency standpoint. From a value creation standpoint, the agents can be extremely hyper personalized, be it offering financial products, doing credit underwriting, providing investment advice on a real-time basis, given the risk profile and the risk signal of a customer. So again, that is a clear value driver. And then perhaps most importantly, agentic AI can drive financial inclusion because By analyzing alternate data sources responsibly and at scale, AI agents can help institutes serve underbanked population, which was only traditionally relying on credit scores. Now there is a lot of alternate data that can be used, and AI can use it on a much better advantage. And obviously, the key is none of this is static. They will adapt as they understand the customer behavior and profile in addition to the evolving market. Clearly those are the ways in which the financial institutes will benefit in the future.
Thank you, Pratik. Now, from a regulatory perspective, what role will the governance and the regulatory innovation play in ensuring that the autonomy of AI system coexists with transparency, ethics, and trust?
I mean, governance is table stakes. It's the defining factor for success of agentic AI or AI for that purpose. As AI gets more and more autonomy, financial institutes must treat digital actors within the organization in the same way as any other employee, which means clear accountability framework, explainability by design, and a very strong continuous monitoring process. So controls will play a big role. Regulatory innovation, including principle-based guidelines, sandbox environments, and outcome focused supervision will also become critical. India's regulatory ecosystem has already demonstrated an ability to balance innovation with stability, and that will be tested as AI systems scale further. Trust will evolve over a period of time. There will have to be a deep-rooted understanding of what decisions the AI agents are making and how they are making, given the regulatory, ethical, and business objectives in mind. And that will get embedded as part of the governance process for financial services as they scale up more responsibly.
Thank you, Pratik. Now, lastly, as we move towards the AI-powered economy, what new leadership, data, and control models will financial firms need to adopt to responsibly harness agentic AI?
I think as we move forward, leadership models will continue to evolve. Financial leaders must shift from overseeing processes to governing the outcome. That requires a very strong understanding of AI capabilities, its limitation, risk implications, right from top of the house at the board level to the executive level, and then obviously percolated down to organization. Data models will mature with focus on quality, interoperability, and how do you manage biases. And obviously, then control models will become a lot more dynamic. So instead of static rules, institutions will need adaptive control that learn alongside AI agents and supported by real-time auditability and obviously human in the loop. I think those who will get this balance right and then adopt AI at scale will clearly differentiate themselves in the market as financial services evolve in India.
Thank you, Pratik. Now, that brings us to the end of this episode. Thank you so much for joining us and sharing all those valuable insights.
Thank you, Pallavi.
Thank you. And thank you to all our listeners. You've been listening to EY.AI Unplugged Season 2, AI Agents of Impact, a special series by EY India Insights to explore more perspectives on how agentic AI is reshaping industries and economies. Visit ey.com/in. Stay tuned as we continue to spotlight leaders driving AI with impact. Until next time, this is Pallavi signing off.